Amazon stock is up, but it's still way cheaper than the market. We discussed already Amazon 2 years ago when it was at 90, much cheaper than now, lower, okay. But I'll show you that it is still cheaper than the market. And back then, the risk and reward was very positive. I think we also bought it for some portfolio, and that's exactly what we do on this channel. We discuss the risk and reward, and that's what I want to give you in this video. And if you like it, please smash that like button and consider subscribing. Let's immediately dig into Amazon's financials. They have always these nice slides, including the trailing 12 months financials, showing you how revenues are growing year by year, quarter over quarter. Operating net income has also boomed, but there is a caveat to that that will come in a moment. Net income is also growing well as they have focused more on profitability, and cash flows, they have certainly optimized those long-term cash flows, and we are now close to 50 billion in free cash flow for the last 12 months. There is one small issue there. If you look at the shares outstanding, there is still management compensation ongoing, and the long-term goal is to efficiently manage dilution. You can manage dilution only by doing buybacks. And the problem is that now, given Amazon's stock price, to manage 100 million shares dilution times 200 the stock price, if I'm correct, that's 20 billion in cash flow cost. 20 billion cash flow cost is, let's say, 40% of the free cash flows that Amazon is having now. But let me show you something better. If I look at the free cash flow from Amazon, as we said, around 50 billion, look at their capital expenditures, what they are investing. Those numbers are going up, and that is now, the last 12 months, 64 billion. I don't think that Amazon would need to spend 64 billion just to keep its position. They are investing in growth and things like that. And if you look at the free cash flows here, so we have 112 billion of operating cash flows, 65 billion spending, and then what's left is free cash flow. If they would spend 30 billion, they would still be great Amazon. If they would spend 15 billion like, I don't know, Apple, then their free cash flow would be 100 billion, which would then completely change the valuation. Let's say that a normalization would be 80 billion of free cash flows. If I compare that to the market capitalization, the P ratio is not 50. The P ratio for Amazon, for normality, is, let's say, 30. So it is still cheaper than the market. It's not cheap as it was, but okay, I'm doing these videos because when the next time such great businesses as Amazon are cheap again, then I might consider buying them again. Because if we look at numbers, the P ratio of the S&P 500 is 30. Walmart is 40, and Walmart has never been and never will be Amazon, so Amazon is now cheaper than Walmart, way cheaper than Apple. We discussed Google looks cheaper, but there was a great fight in the comments whether Google will get disrupted by AI or it will dominate AI. That's a different story, but Amazon is, let's say, given the growth and everything, cheap compared to other things. We have cheaper than the market, great business. Of course, there is a valuation risk, recession. For now, there is no recession in sight, so everything looks good with Amazon. It will always be a great business, great job by Jeff Bezos. The only thing is, how much can I get now? What's the risk and reward? It's certainly not like this, and now it's more risk minus 50-60%, recession, slowdown, investments, this, and the reward, it's unlikely to be a 2x for the next 2, 3, 4, 5 years. So still good, in line or better than the market, even if the market is, let's say, expensive, but very interesting one to follow on how it develops and perhaps buy on temporary issues for such great businesses. Thanks for watching. I'll see you in the next video.